Hi, I'm Bob Woolverton. I'm with Pure Real Estate in Bellevue, Washington, but here on YouTube, I'm known as your Northwest Realty Advisor. If you're going to buy or sell real estate, and that transaction will involve the buyer obtaining a loan for the purchase of the home, you need to understand who carries the risk of financial loss in a financing contingency. When we come back in 8 seconds, I'm going to explain the financing contingency so you'll be better informed and minimize your risk of loss in your real estate transaction. Okay, let's say you have your home on the market and a buyer comes to you with an offer written on a purchase and sale agreement. If that buyer needs to get a loan to buy your home, they are going to introduce a Form 22A along with their purchase and sale agreement. The Form 22A is the financing addendum to the purchase and sale agreement, and it looks like this. So, with this form, what the buyer is saying is, I'd really like to buy your home, but I need to get a loan to be able to do that. Through this financing addendum, I am asking you, Mr. Seller, to take your home off the market while I try to get a loan to purchase your home. In this form, the buyer is identifying the type of loan they're going to apply for and the amount of down payment they'll make, and that triggers their good faith requirement to obtain financing. The Form 22A gives the buyer a legal excuse for failing to perform the terms of the purchase and sale agreement, i.e., a legal excuse for backing out of the deal, if and only if, in spite of the buyer's good faith efforts, meaning they did everything in their power to get the loan, they are unable to get the financing they need. If that happens, the buyer can back out of the deal and recover their earnest money. So, what the financing contingency says, the buyer is asking the seller, please take your home off the market and give me the opportunity to buy your home. In exchange for that consideration, I will make some promises to you. My first promise is I am going to make a good faith effort to get this loan, and I'm inviting you to confirm that I did exactly that. I'm inviting you to stay 100% on top of my loan efforts so you never have to wonder if I'm making a good faith effort towards closing this transaction. I do that by including paragraph 2 into my financing contingency, where I invite you, after 10 days, to submit a Form 22AL to me. Now, the Form 22AL is a request for loan information. The Form 22AL looks like this. It's very basic and is merely asking for the buyer to give a status update on their loan application and to provide that information on the Form 22AP. Now, let's go back to the Form 22A. You'll see the seller has just exercised their option under 2A, request for loan information. 2B gives the buyer 3 days to respond with a Form 22AP that looks like this. On the Form 22AP, the buyer identifies who their lender is, identifies all the information they provided to their lender, and it authorizes the seller to contact the lender to verify the accuracy of the information provided by the buyer. Now, let's talk about risk of financial loss. Here's the question. If this transaction goes all the way to closing date, say 45 days after mutual acceptance, and on that 45th day, we learn that buyer is unable to obtain their financing, is it possible for a financial loss to occur? And the answer is yes. The buyer can be out of their appraisal fee, their inspection fees, and perhaps some other fees involved with their efforts to purchase the home. The seller will have lost time on the market and will have to go back on the market, possibly to a declining market, so their listing price may have to be lower. And we all know when homes go back on the market, there's a stigma attached to that home, as future buyers wonder why the home came back on the market in the first place and didn't sell to the first buyer. They worry there's some sort of defect with the home that caused the first buyer to back out of the deal. Through this financing contingency, the buyer is offering the seller a means to mitigate the risk of loss through exercising their options in paragraphs 2 and 3. Yet in most transactions, paragraphs 2 and 3, which work to the seller's benefit, never get used, leaving a huge burden of financial loss on the shoulders of the seller. Paragraph 2 allows the seller to request loan information and verify the buyer is indeed making a good faith effort. And if not, that lack of good faith effort will waive the financing contingency, which is a benefit to the seller. However, let's say at paragraph 2, everything checked out just fine. Things appear to be moving forward just as planned to closing. Paragraph 3 invites the seller after 30 days to send a Form 22AR, the financing contingency notice, and that form looks like this. This form is basically asking the buyer if they're ready to waive their financing contingency, i.e. remove the contingency as a way to get out of the contract. After 30 days, any competent lender should be able to give an answer if the buyer is going to be approved by underwriting for their loan or if they're not. Now, the buyer can respond to the 22AR in one of two ways. Either indicate on the Form 22AR they are officially waiving their financing contingency, or they can do nothing. If the buyer does nothing, it will be the seller's option to decide if they want to terminate the contract, go back on the market, find a more qualified buyer, or perhaps they already have a more attractive backup offer, or decide if they want to stick it out with this buyer. But either way, it's in the control of the seller, but only if the seller exercises paragraph 3. The point is this: you don't want to get all the way to closing, perhaps as much as 45 days or more after mutual acceptance, only to find out the buyer can't get their loan, especially considering the buyer has offered options to the seller via paragraphs 2 and 3 to verify the buyer's good faith effort to get a loan, and or for the seller to terminate the agreement to mitigate the seller's risk of financial loss if it looks like the buyer will be unable to perform the terms of the purchase and sale agreement. It's just bad real estate practice if a seller's real estate agent does not exercise paragraphs 2 and 3 of the financing contingency. Yet, paragraphs 2 and 3 rarely get exercised. A seller needs to know these options exist and make sure their agent exercises the options to protect the seller's interest. And a buyer should understand these options they are offering in their financing contingency and be prepared to respond to them accordingly. By exercising these options that are available in the financing addendum, a seller will substantially reduce their exposure to financial loss if the buyer fails to get their loan. Therefore, a seller should always exercise these options for their own benefit. Yet the reality is, very few do. I hope you found value in today's video. If you did, click that subscribe button now and click that reminder bell. If you liked today's video, give it a thumbs up. That's feedback to me that I'm giving you information of value. And last but not least, please share this link with someone you know who can benefit from the information on this YouTube channel. If you have any questions or want additional information, you can find my email address and telephone number in the video description below. Call me or email me. I would love to hear from you. I'm Bob Woolverton. I'm with Pure Real Estate in Bellevue, Washington. Here on YouTube, I'm known as your Northwest Realty Advisor. Every week, I post new videos about buying, selling, or investing in real estate, as well as some home tours and listing videos. I'll see you next week.